The US dollar is falling around the world, while American interest rates are shooting up. Are these signs that the world is finally losing confidence in the dollar? Could this be the beginning of the end of the dollar's status as the world's reserve currency? This question is becoming more common, and it's a fair one. That's why we need to look closely at what's happening, the bigger forces behind these moves, and what they might mean for everyone watching from the sidelines. Let's start with the most recent escalation. The US and China are once again clashing over trade. As of mid-April 2025, the US has imposed tariffs totaling 145% on Chinese goods. In response, China retaliated with its own tariffs, reaching 125%. However, Beijing has signaled that it may not continue retaliating even if the US escalates further. Chinese officials have mocked the trade war, saying it's become pointless. American products at this point are too expensive to sell in China. Meanwhile, global markets have entered a period of extreme volatility. Since the start of April, we've seen the S&P 500 swing sharply day after day. Some days begin with rallies, only to collapse in the afternoon. Others reverse, steep morning losses turning into strong closes. It's been chaos. But the real shock isn't just in stocks. The US dollar has been weakening sharply against nearly all major reserve currencies: the euro, the British pound, the Japanese yen, the Swiss franc. The dollar index, which measures the dollar against a basket of major currencies, dropped below the key 100 level and recently hit 99. That signals clear dollar weakness. And while the dollar falls, interest rates in the US are rising fast. This is a highly unusual and worrying signal. Normally, higher interest rates would attract global investors to the dollar since they'd earn more for holding US debt. But the opposite is happening. Foreign investors are selling off both the dollar and US treasuries, which drives rates up even further. That's a red flag. It means confidence is fading, not growing. Might be a good idea to stick around subscribing to the channel. This story is far from over. The 10-year Treasury yield, a key benchmark for the global economy, has jumped above 4.5%, recently touching 4.7%. The 30-year yield is close to breaking through the 5% barrier. When yields rise like this, it becomes more expensive for the US to service its massive debt. This adds enormous pressure on government finances and increases the risk of a broader financial crunch. It's not just America. Japan's 30-year government bonds just spiked to 2.8%, the highest in 2 decades. In contrast, German 30-year bonds are falling as the euro strengthens sharply against the dollar. All of this shows that something is breaking the usual patterns. Currencies, yields, and market behavior are no longer following the rules. And then there's gold. The metal surged past $3,300 an ounce. That's a massive move. Gold tends to spike when investors are looking for safety and losing trust in fiat currencies. Bitcoin has been doing the same recently, climbing past $85,000 as people search for alternatives. Even more unusual is how disconnected everything feels. Normally, when bond yields go up, stocks go down, and vice versa. But for several days this month, both were rising at the same time, which is rare and doesn't make much sense. Then they both flipped again. It's like the market can't decide what story it believes. These mixed signals aren't normal, and when things move like this without a clear direction, it usually means something deeper is wrong. It's a sign that the financial system is under real pressure. So, is the world really losing faith in the dollar? It's possible, but it's also partly intentional. Behind the scenes, Trump's economic team is reportedly pursuing a plan that would involve weakening the dollar on purpose. The idea is to boost American manufacturing, reduce trade deficits, and regain competitiveness, especially against China. Some are calling it the Mar-a-Lago Accord, a spiritual successor to the Plaza Accord of 1985. The theory is this: a weaker dollar would make U.S. exports cheaper and help bring factories back home. It could also reduce reliance on foreign imports and reshape global trade flows, but the cost of this plan is steep, because a weaker dollar makes U.S. debt less attractive. If investors lose trust and start dumping U.S. treasuries, interest rates rise, debt becomes harder to manage, and the entire strategy could unravel. In other words, this is a dangerous game. If everything goes smoothly, the dollar gets weaker but stays dominant. If it doesn't, the US could lose both control of inflation and global confidence in its currency. Even though US leadership is stronger now compared to the previous administration, it's still weaker than it was back in 2007, when the dollar index dropped to around 70. At the time, countries in the Gulf were openly debating whether to drop their peg to the US dollar. But then the global financial crisis hit, and ironically, the dollar came out even stronger. Could this time be different? Maybe. The debt levels are higher, global trust in US leadership is weaker, and there are now real alternatives like gold, the euro, and even Bitcoin. A weaker dollar means a stronger Bitcoin. This isn't the end of the dollar. But something has changed. What used to be impossible, a world moving away from the dollar, might be happening sooner than most people ever imagined. Stay informed, stay prepared, keep watching the signs, and as always, stay curious and stay hodling.